Crisis can be of many types. There are financial crises like a bank crisis, currency crisis, etc. Then there are economic crises like a debt crisis or a housing bubble. There's social crisis like unemployment and food shortages. There are environmental crises, political crises, and of course there is international crisis which is being played now with what we are seeing in Ukraine, with the entire world being involved and concerned in some capacity. Now, the general reaction amongst investors in a crisis is to be loss averse rather than being risk averse, which means investors panic, they behave irrationally even before the war starts, and eventually end up selling even those assets which have a favorable reward risk ratio. But having said this, we cannot ignore the fact that investing in a crisis is risky. There are real possibilities of double dip recessions, large falls in share prices, and there is no guarantee of the extent to which investing models would succumb to fear and anxiety. And so in this video, we shall examine war as one such external crisis and examine how investors can use those unnerving periods as an opportunity to modify their portfolio for future investing success. Let's begin. While there are a few investments that tend to do well during times of war, most asset classes, most sectors and industries struggle during this period. I mean, there are some real issues in the form of trade disruptions, sanctions, inflation, tariffs, the availability of raw materials, etc. And consequently, a 10 to 30% drop in value is pretty common even for countries and companies which are not involved in that conflict. For instance, Ukraine and Russia play important roles in the commodity markets. Ukraine is one of the largest producers of wheat and cooking oil, while Russia is the world's largest producer of nickel, the second largest producer of natural gas, and the third largest producer of oil. These disruptions might and probably will have a substantial inflationary impact on our economy, which is likely to give the Reserve Bank of India more headaches as it continues to stick with low interest rates in order to keep the economy buoyant. But beyond these economic and monetary parameters, a more important lesson while equity markets drop fast on the onset of war are the irrational, panic-driven perceptions that people draw. For instance, a common thought is that the stock markets will completely crash. Now, completely doesn't mean 100% annihilation, but the general assumption is a 30, 40, 50% fall, which when we go through history doesn't really seem to matter over a 1 or 2 year period. This was illustrated by David Dreman in his book, The New Contrarian Investment Strategy, where he mapped out major conflict events in the post-World War II period and put forth an average jump of 37% within 2 years of those conflicts, which not only wiped out the losses but also exhibited a noteworthy uplift in the broad market index. The reality is, over an year or two, indices of most countries go on to adjust to the new reality and then generally continue their growth trajectory. In fact, we saw a similar trend closer to home when we put together a list of major conflicts, terrorist attacks, and events that have directly affected us as Indians or our places where we have participated in. Here too, while the first week saw a fall in the Nifty in many cases, we find that the Indian stock markets have sufficiently recovered within an year of the event. So if you are a long-term investor like me, then this is certainly some useful information for you to consider. One of the ripple effects of a crisis is the abundance of opportunities. In fact, many studies show that crisis periods often account for much of the excess returns that superior investors make over the average ones. And for a large part, it's the amateur investor who needs to be blamed, as he or she is the one who partakes in abnormally bad behavior during these periods. Now, historically, equity investors react to a crisis by moving their portfolio to relatively safer investments like technology, utility, consumer staples, defensive mutual funds, etc. But that's no guarantee that these are sure winners in such times. At best, these moves can help deflect some blows, but they don't do that as well a job to qualify as taking advantage of a situation. Which brings us to a second technique that more sophisticated investors use, which is to make money on the crisis that is likely to happen. The idea here is simple and involves the short selling of stocks or index futures which take advantage of a forthcoming bear market. Simply put, a short seller borrows shares that he or she does not already own and sells them in the hope of buying them back at a lower price. A related strategy which is a bit more sophisticated is the use of options which can be applied on equities, bonds, and even the commodity market to good effect. Of course, I should mention that these instruments are not as straightforward as buying units in a mutual fund or shares, and it is in the investor's interest to learn everything about these variations and features before applying your money on them. In my opinion, a lot of this is not really necessary if an investor has a well-diversified multi-asset portfolio which is adequately rebalanced from time to time. And if you're still a little away from getting there, then do explore ET Money Genius, which does just that with 6 smartly crafted portfolios across mutual funds, stocks, and exchange traded funds. To say it like a list of features, Genius does multi-asset allocation across different asset classes so that your money is where the opportunity is. Genius manages portfolio risk on a 24/7 basis. It rebalances periodically. It aligns itself to an investor's multiple goals. And most importantly, Genius is geared to give you higher than benchmark returns, consistent returns, and is designed to reduce volatility and protect portfolio downside. So if you haven't tried Genius yet, then do subscribe to it on the ET Money app and give your portfolio the investing intelligence that it truly deserves. Okay, so what else can investors do if the war begins and stocks start to fall by 15 to 20%? Well, for one, it's the perfect time to get your shopping list out. That is your list of high quality companies that you have been wanting to buy on the cheap for some time now. So how would a high quality company look like? Now, outside of the valuation metrics, economic moats, and other characteristics that we have discussed in some of our previous videos, we see 4 additional attributes that can be used to identify high quality companies specifically at the time of crisis. So firstly, and in our opinion, you might want to look at non-financial companies as your first filter. And it's not that we have anything against financial companies, but the idea here is to pick companies that deal in essential and small ticket items that the average Indian needs on an everyday basis. You know, things like milk, medicine, rice, wheat, soap, etc. These are too important a product or service for people to postpone consumption, and since these are essential, the government too would always do their best to ensure uninterrupted supply. Having said this, what you want to avoid are discretionary sectors like jewelry, automobiles, the movie theater business, investing in travel businesses, etc., as these businesses do take a lot more time to recover and flourish. The second thing you might want to look at are companies who own or control their supply chain. You see, when a crisis like a war hits us, the supply chain is the first thing that gets damaged, and any hits in production comes in much later. In that context, you want companies in your portfolio that have fewer layers in their operations. For instance, it's generally seen that companies that use direct distributors find their feet a lot faster than ones that use wholesalers. Likewise, firms that have their own B2C channel like showrooms, diagnostic labs, etc. have a lot more control and are likely to rebound faster than others who rely on third parties. A third characteristic, or more of a signal that comes out during crisis times, is the grace with which a company manages the interest of its stakeholders like suppliers, vendors, and distributors. For example, when COVID struck, some companies extended an extra 60 days of credit to their distributors or even gave working capital loans to the showrooms to manage their situation better. This is a proxy that shows the company's balance sheet strength, which also means that they can not only survive the crisis but can increase their market share when weaker firms fall by the wayside. And speaking of market share, a crisis period almost always sees a market share shift from the unorganized sector to more organized players. This aligns with the survival of the fittest and strongest principle, as the strong grow stronger and the smaller, weaker players tend to lose steam and die. In that context, look out for companies that are in industries with growing demand, that have more scope for premiumization, have capacities to plug in the supply gap, and are serious brand players who are ready to up their advertising budgets when everyone else is covering for cover. Some industries that you can explore here include packaged goods, footwears, textiles, logistics, electronic equipments, etc. Of course, there is no denying that all of this requires some pre-work, and what would certainly help is for you to read up a report or two about some of these sectors, which will give you a good idea of where things are moving within that sector. Yet another strategy you can utilize during these times when your stocks are 15 to 20% down is tax loss harvesting. Now, we have a video and a blog on this that explains the concept in greater details, but in simpler terms, tax harvesting is a technique that helps reduce an investor's tax liability by selling stocks or mutual fund units at a loss and offsetting it with any capital gains that you might have made. It's a perfectly legal way of saving taxes, and crisis times do offer an opportunity for you to do that, and it's something that you should take an advantage of. To conclude, the fact remains that we are never away from a financial crisis, and geopolitical events like wars, terrorist attacks, threats, and intimidations are becoming more common. Most investors tend to panic in such scenarios and almost never act rationally. And the ones who keep their cool and think analytically are the ones who not only survive, but they flourish when the markets finally rebound. I hope today's video has helped you better understand these patterns with enough clues on what one can do to take advantage of these unfortunate situations. If you have been handling the crisis differently, then do share your investing experience with us in the comments box below. Thank you for your time. Do tap on that like button. Don't forget to subscribe to our channel. Do explore Genius, and I look forward to catching up with you next week on another video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.